Hi everybody. Welcome to a series of video lectures about accounting for long-term contracts, Chapter 6 in your textbook. Before you watch these videos, you should be sure to thoroughly study Chapter 6 because these videos will only discuss the highlights of the chapter. As discussed at the beginning of Chapter 6, there are 5 steps to recognizing revenue. Identify the contract, identify the performance obligations, determine the transaction price, allocate the transaction price, and recognize revenue when or as each performance obligation is satisfied. Long-term contracts are complex and require specialized accounting approaches that have been developed to handle the complexity. Of the 5 steps to recognizing revenue, steps 2 and 5 are critical for long-term contracts. Step 2 is important because it is important to identify the performance obligations in the contract, because long-term contracts typically include many products and services that could be viewed as separate performance obligations. These products and services are capable of being distinct, but they are not separately identifiable, because the seller's role is to combine those products and services for purposes of delivering a completed project to the customer. Therefore, it's the bundle of products and services that comprise a single performance obligation. Step 5, recognizing revenue when or as each performance obligation is satisfied, is important because there can be a considerable difference for a long-term contracts between recognizing revenue over time and recognizing revenue only when the contract has been completed. For many years, long-term contracts that qualified for revenue recognition over time were accounted for using an approach called percentage of completion method, which recognized revenue in each year of the contract according to the progress towards completion that occurred during that year. Long-term contracts that didn't qualify for revenue recognition over time were accounted for using an approach called the completed contract method, because all revenue was recognized at a single point in time upon completion of the contracts. Most long-term contracts qualify for revenue recognition over time. The Accounting Standards Update 2014-09 removed the terms percentage of completion method and completed contract method from the Accounting Standards Codification. But the journal entries necessary to account for long-term contracts did not change. We will discuss those journal entries in this series of video lectures. Illustration 6-25 in your textbook shows an example of a long-term construction contract. We will refer to this illustration frequently during these lectures, so I suggest you flag this page for future reference. To understand revenue recognition on long-term construction contracts, let's walk through this illustration. At the beginning of 2021, the Harding Construction Company received a contract to build an office building for $5 million. Harding will construct the building according to specifications provided by the buyer, and the project is estimated to take 3 years to complete. According to the contract, Harding will bill the buyer in installments over the construction period according to a pre-arranged schedule. Information related to the contract is showing in your textbook illustration and on this slide. Construction costs incurred during each of the 3 years are $1,500,000 in 21, $1 million in 22, and $1,600,000 in 2023. If you add those three amounts up, the total construction costs for the entire project are $4,100,000. The billings made each year, according to the prearranged billing schedule, were $1,200,000 billed in 2021, $2 million billed in 2022, and $1,800,000 billed in 2023. Add those three numbers up and you will see that the total billings to the customer equaled the $5 million contract with the customer. And then cash collected against the receivables each year were $1 million in 2021, $1,400,000 in 2022, and $2,600,000 in 2023, which means that by the end of 2023, the full $5 million billed to the customer was collected from the customer. Illustration 6-25A in your textbook shows the journal entries required during each year of the contract to record construction costs, billings, and cash collections. Let's look at the accounting for cost of construction and accounts receivable for Harding for this long-term contract. These journal entries are not affected by the timing of revenue recognition. The first journal entry shows Harding incurring various construction costs during the construction in process and recording them as an asset called construction in progress. That is abbreviated CIP for short. Construction in progress, CIP. So in each year, as the construction costs are incurred, Harding debits an asset account called construction in progress and credits cash or materials, etc. And over the 3-year period of time, the asset account, construction in progress, grew to a total of $4,100,000. The second journal entry occurs when Harding bills its customer according to whatever schedule the contract permits. Notice that periodic billings are credited to billings on construction contract. This is a contra asset account. It attaches itself to construction in progress, or CIP, and has the opposite normal balance. At the end of each period, the balance in these two accounts are compared. If the net amount is a debit, it is reported in the balance sheet as a contract asset and might be named something such as construction in progress in excess of billings. Conversely, if the net amount is a credit, it is reported as a contract liability and might be named billings in excess of construction in progress or something similar. The third journal entry simply records the receipt of payments against the billings from the customer. Now this is an asset account with a normal debit balance. And this is a contra asset account with a normal credit balance. As a and of course accounts receivable is asset account with a normal debit balance. So as a natural result of recording these journal entries, Harding's balance sheet will show accounts receivable as a current asset and will show either a contract asset for construction in progress in excess of billings, and that's if CIP is greater than the billings on construction in progress, or it will show a contract liability for billings in excess of construction in progress, and that's if these billings are greater than the CIP. It is important to notice that none of these journal entries record any revenue or expense to be reported in the income statement. Instead, all construction costs are recorded as an asset, construction in progress, and all billings on the contract are recorded as a contra asset, billings on construction contract, not revenue. It's a contra asset account. And the balance sheet shows the net amount of these two accounts. Well, that's all for this video. In the next video, we'll begin a discussion of revenue recognition for long-term contracts. See you next time.